So hello everyone. It's July 22nd, 2025, and Brad and I are going to do a mid-year market outlook. I'm hoping to take care of a little housekeeping before we get started. And we have another webinar that hasn't been announced yet. It's going to be in September. We haven't got the exact date yet with Michael Townsend, who's the managing director of legislative and regulatory affairs over at Charles Schwab. He's a big wig over there. We're going to jump into the crypto, going mainstream. We're going to talk more about in detail about this massive tax and spending bill, aka the big beautiful, all the B's, big beautiful bill, as it's been named. And we'll get into more details there. We'll touch on it today, but we're going to fly above it somewhat. And we're going to let him get into a lot of the details in that September call. So I have a colleague that's wrote something, a quarterly update, and he talked about the Rip Van Winkle effect, right? If we slept through the winter and the spring, and we woke up now and looked at where markets are standing, we look at it and say, pretty, okay year. Some of the returns are pretty good across the board, and we'll touch on it in a little bit. And I just went back from a family vacation to Greece in late June and into early July and kind of decompressed from the PTSD from the spring. and and I saw an interesting stat from Liz Ann Saunders on July 17th. At that point, the S&P was up 7%. At one point in the year, it was down 19% for the S&P 500. And if you looked at the average stock within the S&P 500, it was down 24%. And since April 8th, it's rebounded 26%. So much for trying to market time anything in this world, right? Who would have thought, right? It kind of reminds me back to the days of the pandemic when markets were falling like a stone and the world was ending, only to see them rally. So with that, I'm going to pass the ball back to you, Brad, to kind of recap a little bit of where we started. We had this call, a similar call to this in January, reflect a bit, and then begin to look forward.
Yeah, it's that level of volatility, right? I think it speaks really well to our themes, but it also speaks to the idea of, long term and being long term in portfolios. Markets and compounding, right? That's the eighth wonder of the world, right? So if you would have been emotional and reacted in a material way in April, you would have avoided or lost a lot of the gains that you just mentioned. But part of how we help keep our emotions in check, because that's a hard thing to do, right? We're human beings, and as investors, right, investing can be emotional. It's either our retirement or it's part of an organization that we serve. And so building kind of thoughtfully diversified portfolios that we think have a high probability of going to where the puck is going, right? So when we do that, we set forward every year a couple of key themes that we think are really going to be driving prices and volatility. And we talk about those as our themes. And our themes for 2025, again, kind of if you rewind the mental clock and going back to, December of 2024, we were really positioning portfolios for a handful of things. And the themes that were coming through were the following. The first is this idea of fragility, right? So high valuations here in the US. That's really kind of large cap specifically in the US, but there are other pockets of that as well. So high valuations, concentrated indices. We're off of peak concentrations, but just by a hair. And then the risk of inflation reigniting, right? We saw that playbook in 2022 and how that rolls through prices and volatility in markets, both in equity and fixed income. So, with this idea of fragility, and by the way, April bore out, that kind of idea of fragility in prices and markets. Like, what do we do as a response? And so we talked a lot about durability, right? And the intentionality of establishing portfolio positioning. So we'll get into this throughout the presentation, but kind of later on, how are we positioning U.S. versus non-U.S. in our equity portfolios? How do we position our fixed income portfolios with the idea that inflation might rear its ugly head, or we continue to add to the deficit? I know we'll probably talk about that in a little bit. And then how do we potentially utilize alternatives to that end to help us achieve long-term goals? Which does get to this third theme around the idea of age of alpha. Now, there's no market that, based on macro conditions or, anything else, that what was hard to achieve before becomes easy to achieve now, right? It's still hard to outperform the S&P 500. That's a great index. It's one that, we're often passive investors or maybe tax efficient investors in that way. But on the margin, right, it does, these preconditions of valuation, inflation, and concentration do sow the seeds, what we think, for a good environment for active management. And just all else equal, if we take a step back, that's an environment where we want more of our hands on the wheel, right, with active management versus, more autopilot with passive. And so, the themes that we wrote in the beginning of the year, the positioning that we put into portfolio, frankly, it's just as relevant today as it was the day we implemented them, maybe even, if so more. Obviously, as even more context is coming through as we roll through the remainder of the year. So, in short, right, positioning when we came into the year, we still feel very confident about that, and frankly think it's well poised for the second half and beyond.
It's funny. Someone once said, I heard a quote, be prepared to get lucky, right? By just putting the pieces together and being thoughtful about how you do it. You don't necessarily have to have that crystal ball, because none of us do. But you can position yourself well, regardless of what takes place. Couple of things. So I'm gonna zoom out for a sec, just escape a couple of times. So we have a bunch of things that people are thinking a lot about. Tariffs was a huge issue early in the spring. So we've got tariffs. We had the U.S. dollar falling, which led some people to be concerned about people wanting to invest in the U.S. and so on and so forth, and the U.S. remained the central currency. The Fed speak. There's been a lot of talk in and around that. And I know we've got some interesting things to talk about around that in terms of the makeup of the Fed and how it actually works. So let's touch on some of those. And as we do, we can then get into equity asset classes and go from there. And I'll let you take them in any order you'd like.
Yeah. Well, let's go chronological, right? Let's start with tariffs and then we can work our way into the Fed because I think
Sure.
there's a logical progression there. So tariffs, let's again, kind of prepare to get lucky, right? You use a little bit of data and math on your side. It often helps in the probabilities of luck. So today, where do we sit with tariffs, right? So April, we have Liberation Day. We create this, 90-day arbitrary pause just after a few days that those go live. That passed earlier in July. That's been extended to to August 1st. Still somewhat of an arbitrary timeline. If we look back over history, right, kind of a launch to signing, average here all the way on the left, 18 months. So to think that we could have got this done in 3 months, it was already a bit Pollyanna. Even we extend it to 4, it's still it has some ways to go.
Brad, a
Now,
question on that.
yeah,
So start to finish, I get the 18-month period, but for some version, for lack of a better term, in M&A terms, a letter of intent,
yeah.
um, where, hey, listen, here's the outline of what we're thinking about, and I know there's a lot of details to be filled in. Any thoughts in terms of that in the context of everything we're speaking about?
Yeah, it is the exact right point, right? So the letter of intent, if you will, would be the dark blue bars here. The
Okay.
light blue bars is the actual implementation, not just signing it, but getting it
Okay.
done, dollars exchanging hands. That's at 45 months. And by the way, Mike, you're right. Like we don't need resolution. We just need context, right? Of like
Mhm.
what this could ultimately look like. And we have a little bit of that today. Now, we don't have a full painted picture, but we might have a bit of the borders. Uh, Today we have a couple of key signed deals we think are going to be meaningful going forward. One is with the UK, so the United States. If you remember, in the Rose Garden with a big, cardboard box, or looking over the various, reciprocal tariffs. A big part of that calculus at the time was our trade deficit with these countries. The United States actually has a trade surplus with the United Kingdom. We have an inked deal with them, and it's at 10%. So, given strong relation, good economic alignment, and we have a trade surplus with them, you can largely think of 10% as the floor. Like, not too many countries are going to do better than that. Beyond that, we've also inked a deal with Vietnam. So Vietnam has a cozy relationship with China. China's kind of a separate ball of wax here, which we'll get into in a
Mhm.
moment, but cozy relationship with China, high trade deficit with the United States. We have inked a deal with them. It's a 20% flat tariff plus 40% on transshipped goods. So you can think of the effective tariff as like high 20s, mid 30s. Um,
That's one of the bookends you're speaking of.
That's call that a ceiling, right?
Okay.
Now we don't know is will someone be a little bit above that potentially where, kind of where does Japan live in the middle? Where does, India live in the middle? But we think, by and large, now we've got a little bit of the playbook here on the bookends of what's our high and what's our low. So as we're working through this, right, we can start to have some semblance of what it might look like on the other side. But I will say we are still definitely in limbo. Now, what we're talking about is country-based tariffs. But remember, there are many other tariffs that have already been implemented, including Canada and Mexico. Those are not included in these negotiations on, the Liberation Day Rose Garden. That was part of, kind of the new NAFTA, if you will. But we have sectoral tariffs, and giving you a good example of that today. So GM reported earnings as they regularly do for Q2. Those came out today, stocks down about 7%. They're calling out a $1.1 billion hit to earnings based on auto tariffs that were implemented earlier. So these are real live dollar, influences in our economy, in our market, potentially to inflation. So as these tariffs start to kind of roll together and truly come to shape, right, what they look like in between those bookends and their ultimate impact, that's starting to, kind of finally hit the, the balance sheets of companies, the balance sheets of consumers, us, spenders, investors, as opposed to just kind of the theoretical implementation. They're becoming live data.
Who's picking? I've heard the theory that it's more or less being picked up one third, one third, and one third along the chain, with consumers picking up the final third. And I know inflation data. The administration keeps touting inflation data not being bad so far, and I think the Fed and others are saying, well, you got to wait. We had inventories we're working off, and so on and so forth. So, when do you think we might get a handle on what the inflationary effects of all this are, and then how might that affect markets?
Yeah, it's complex. So a couple of things. We had inflation data last week, right at 2.7 annualized. Fed's target's 2. That's been creeping up. Now 2.7, like we could all live with that forever, even though the Fed's target is 2%. That's not a horrible number by any means. Who actually pays inflation, right? That's fairly simple. It's just the proportions, as you mentioned, Mike, that can be more complicated. So these are, call it taxes effectively, on foreign countries or entities. Those businesses, they have a decision, right? So now that the cost of that good is more expensive, they can eat it, meaning they'll make less money per product that they sell.
Mhm.
They can pass it along, meaning you and I will have to buy that good at a higher price, or some combination in between. Most of the time, it's the latter of all of those, right? Where they say, okay, I can probably increase prices a little bit, but if I go too far above, actually people are going to purchase less of my goods. And so I can't push on all of it. I have to eat some of it. So that means, corporations, the amount that they earn will shrink. The other complicating factor here is if you think about we're taxing foreign goods coming into the United States.
Mhm.
So as that good hits the border, that's actually the point that the tariffs we're talking about is paid. Then ultimately it goes from, LA or Louisiana or Houston, like whatever port it comes into, and works its way to a final good that we buy. And there's cost in between there. So if it costs $1 when it hit the port with a 40% tax, it costs $1.40. But you're still adding on top of it beyond that. So it's a bit of a diluting effect.
So you think
Um,
by the end of the year we'll have a handle on what the true inflationary effects are?
we will. We'll have run through the inventories that you mentioned. If we have, tariffs in the ground and implemented, right? The soft date today is August 1st, but we'll see. If we have that in there, we'll actually see what that's doing to consumer behavior, what that's doing to prices, and mechanically, we'll probably see a stair step on price. The question is, will it sustain there, or will it, ultimately come back down?
Okay. So that's tariffs, but I think the shock and awe of tariffs seems to be gone from April. Some of this has obviously been factored into the market, and obviously could be more adjustments along the way as they expand or decrease, I would think.
Yeah. Yeah, it's we would say the shock and awe, like all you could read about or hear about or think about on April 2nd through 7th was tariffs. And now, there is still a headline, don't get me wrong, but there's a little bit of um, mental laziness, I think, by the market or complacency associated with tariffs today. just because they're really now, coming up front. But certainly there's more going on with tariffs. I know you mentioned earlier, right? What's going on in the Fed? That's a big headline, today. U.S. dollar strength and the reserve currency status going forward. I don't know, Mike,
Let's
which of
let's talk
those?
let's talk over to the Fed then.
Yeah.
This is-
Um, so, speaking of the topic du jour, right? Like, is Jerome Powell going to be fired? He's the Fed chairman. What does that mean for the Fed going forward? Have we lost Fed independence? I would say there's a little bit of like fact and fiction associated with, what's going on or what's being said, and how the Fed actually works. So at the risk of maybe kind of going too far into the bowels of the Fed, give a little bit of pre-context of how the Fed actually operates, and frankly, how we think it, while imperfect, there's no question about it, it definitely remains independent. I will pull up a graphic here. It's kind of one of those pictures is worth 1,000 words, because the idea that the Fed chair will either his term, which expires in May of next year, or if he's fired, that you remove the Fed chair, put in a new Fed chair, and then all of a sudden, the Fed board becomes, Donald Trump's, to do with as he pleases. That is just an oversimplified and frankly not true or factual narrative. So the FOMC, the Federal Markets Committee, there's 12 board members that sit there, and requires a majority vote for any decision like changing interest rates to be approved. So that's 7 or more. The president has the pleasure of approving at least 2 in their 4-year given term. Those terms are for 14 years. So just about how the math works, right? They get at least 2. Now, practically, Fed governors do not sit for all 14 years. Oftentimes they go on to another role. So there is turnover of the board. So average there is about 6 years. So minimum of 2 appointments, but usually there's a few more mixed in there. Now you notice I said 12 members, but the president, confirmed by the Senate, appoints 7. The remaining, which have nothing to do with the executive branch appointment, come from the banking system. So Jay Williams, right next to Jay Powell, he's the head of the New York Federal Reserve. That is a permanent seat on the FOMC. Then you have other board members. I live, and work here in Chicago. Austin Goolsbee in the bottom right. He is the Chicago Fed chair. He will be on the board for 1 year and rotate, and then the chair from St. Louis will come in. Right, so it's a robust and diverse board that frankly requires at least 7 votes to move anything forward. So this idea that you have this kind of chair autocracy and you just pull one person out, add one person in, and then therefore Fed independence is gone, it's not true. Now, I know, the idea of firing the Fed has come up, that is enshrined in kind of historical legal doctrine. FDR tried to fire the head of the FTC. Frankly, that went all the way to the Supreme Court under Humphrey's executor, and they said you can't appoint or you can't remove someone for pleasure. It has to be for for violating their position. So could you see Powell fired? Maybe for mismanagement of redesigning the Fed building. It's possible. It's not really probable. But the narrative around Fed independence is gone, because chairman can be extracted. It's just far more complicated than that. So while they are an imperfect institution, and we know that, we do think they remain independent.
So he's 1 vote out of 12, but then he exerts influence, I would guess, on other members.
Yep. And as you can see in that board, like some believe interest rates should be higher, some sit in the middle, some should be lower. And that's not a surprise. At this point in the economic cycle, frankly, you would expect disagreement among Fed's members. If you had uniformity of opinion, right, they're operating with imperfect information, trying to make the best decision they can, just like the rest of us. So it's zero surprise there's not uniformity.
Pause right here. Even if the Fed lowers rates, the Fed controls the short end of the curve, correct?
Exactly
the longer
right.
end of the curve is the market, right? And the longer end of the curve would influence, tell me if I'm wrong, the 10-year treasury, which influences mortgage rates and that sort of thing. So the short end of the curve, I'm guessing, would maybe influence more auto loans and shorter term loans and things like that. And potentially the cost of government, given that the government did not finance the debt with a lot of longer term debt, shorter term debt, it's going to help make Uncle Sam's payments lower. Is that correct?
That's exactly right. So the Federal Open Markets rate, right, that the Fed decides to charge, that is the overnight, like about as short as you can get. It's the overnight lending ranks between banks. And by the way, that's what the Fed does, is it regulates the banking system, and part of that purview is setting that rate. The market controls the rest, right? So what happens in the 30-year or the 10-year or the 2-year? That is investors buying and selling and setting the rate on prevailing views of what they think the economy is doing or what they think inflation is doing. Your point on what sets longer rates, things like mortgage rates, auto rates, that is definitely the longer end of the curve. And frankly, the longest part of the curve, the 30-year, it's going to be pretty emotionally charged in this environment. So the 30-year has the most influence over these big things that we really haven't solved. So debt and deficit spending, we have 120% debt to GDP. OBBB, one big beautiful bill, added 3.4 trillion to that deficit over an annualized 10-year rate. We're spending at a rate of deficits that we normally would spend in a recession. Yet here we are not in a recession, and we're spending at those high rates. So, the long end of the curve is going to be influenced and has been, frankly, influenced by some of these bigger, broader, longer term issues. Whereas the 10-year or the, kind of inside of that still influenced, don't get me wrong, but will be less sensitive. So we'd say, investors that are really thinking, well, hey, I don't know what's going to happen, I should just buy long bonds. That's definitely going to be a buckle up asset for quite some time, just because, of these bigger, broader, like mega trends that are going to influence the long part of the market.
Why don't we swing over to fixed income then? I know you've got a chart on that, and maybe we can talk about some interest rate moves and what happens in and around fixed income.
Yeah. I mean, if we think about fixed income today, just in aggregate, right, it's a space where we think it's quite attractive. There's a lot of opportunities within fixed income. And, if we pause and just think what is the opportunity in fixed income? It's yields. And yields today, as we look across, a variety of different fixed income instruments, whether it's cash over here on the short end, things like municipal bonds here, or TIPS, which we added in portfolios and increase, the yield, the higher this number on this chart, the more attractive it is relative to the last 20 years. So effectively, it's telling us, hey, yields are interesting, not just relative to history, but even on an absolute basis.
So
Now,
take the ag, for example. Right now, the ag is at 4.5%.
exactly. Yep.
And
And
relative to history,
yep, it's top quartile. It's kind of it's near the top of where it's been over the last 20 years.
yeah,
Now,
to me,
what's
the interesting part is exactly what you just highlighted. If you're going out searching for yield, you take it from there.
Yeah. I mean, this is, even though yields are high because interest rates have gone up, the compensation for credit within fixed income is fairly modest, right? So how much you earn above a treasury, which is presumed to be a risk-free asset that the United States won't default. And then you add a little bit on top of that. Today, those are incredibly low. And so, investors are, in our view, not really being compensated to take on a ton of credit risk. And then, so that, as you think about it, its yields on an absolute basis are very interesting. Credit risk, is somewhat questionable. And we did just talk about this idea of interest rate risk, right? So, the long end of the portfolio, right, is going to be very emotionally charged, almost mathematically because of what it is, but also practically because of what's at stake. Things like
Brad, why
debt
don't you
and
walk us
deficit
through,
policy.
just even take the 30-year treasury, then the ag, and just walk us through what those three different colors represent.
Sure. So the 30-year treasury, again, that's a very long US government debt instrument. Today, that yields around 4.8%, right? So that's your expected return if you were to buy that today and hold it for the next 30 years. If interest rates were to go up, right? So as interest rates go up, bond prices go down. You could see mathematically that bond price fall by 11%. If interest rates were to go down, you could see that bond price go up by 20%. Now, first off, the skew of those are good, right? The upside is better than the downside. But it's that what we're describing is duration or interest rate risk. That's a very highly sensitive part of the curve. Just because of the math of how these assets work, but also because of those things that we mentioned before on, what is going on in the market and trying to solve these really long-term issues, which is, debt and deficits and fiscal policy. Now, this is the ag, right? So the
And by the
S&P
way,
of
this
fixed
is
income.
most of our clients don't live in the 30-year. They live somewhere around the ag.
Yeah,
They're in fixed
exactly.
income.
Now, this is a far more attractive profile. So you're still getting 4.5, right? Versus 4.8. So it's not like you're leaving a lot of money on the table. If interest rates go down, no one likes to lose money, but down 1.6%, that's not all that catastrophic. I'm sorry, if interest rates go up,
Oh, yeah.
you down 1.6%. If interest rates go down, producing a double-digit return in high quality fixed income, that skew is even more powerful. So as you think about kind of on the far downside here, you have kind of the overnight rate from the Fed, and on the long end you have a 30. We think in just the kind of Goldilocks, too hot, too cold, just right. Like the intermediate is fairly attractive. You can earn a substantial yield. We do think ultimately the direction of interest rates is lower, right? So it creates, a little bit more of a probability that these blue bars will show up, the light blue ones versus the dark blue. But you don't have to bet the farm on it. And so it does create, a lot of opportunity in the intermediate part of the curve, which is how our portfolios are positioned today.
So we look at fixed income. Overall, looks like a pretty good deal overall right now. Now let's go over and look at equities, and we can start in the U.S., then move to international to see what's been going on. But I think we have some interesting things to report in and around equities and valuations and so on.
So, we mentioned fragility at the outset, right? Part of the underpinning of fragility is this idea of valuation. So if things are expensive, what is the path forward? How do we generate a return? One of the ways we can break this down, and admittedly, this is simple, is to look at earnings per share. So basically the net economic value a business or an index produces and what we're willing to pay for it, which is the forward priced earnings. So just to orient with this chart, 0 is where we are today. It's the earnings per share and what investors in aggregate are willing to pay. And so that's a 0% change.
So we're currently at 22 roughly PE ratio, and it's okay. We've got you there.
Exactly. Now, you can start to see the sensitivity to changes in valuation, which would be going up and down here, or meeting or falling behind earnings expectations. So this year, 2025 earnings expectations are around 6%. And so if, valuations stayed exactly where they are, but we were to meet consensus earnings, we'd expect largely, call it a 6% rise in markets. Now you can see conversely, right? If earnings were to stay exactly where they were, but we were to fall to a 10-year average of what investors are willing to pay, right? You can see some downside there. There's a lot more red on this screen than there is green.
So
Now,
here's where the art, I guess, comes in, right?
exactly.
If you're believers in AI and in the shorter to intermediate term, this big, beautiful bill, stokes the economy and companies can write off things at 100% all at once and so on and so forth. So if you're falling into that camp, you would acknowledge things are expensive, yet seems to be some room for upside, right?
Yep. Exactly right. And by the way, just because there's more red, it doesn't mean there's no green. And there was quite a bit. There would have, if you had this exact graph up last year, there would have been a lot of red on there, and we had a double-digit year, right? Also, another reason to our opening comments of why not to time the market.
Sure.
But it does mean that we should be intentional around our allocations and why. Part of that is our international positioning, which year to date has been very additive to portfolios. International developed markets up almost 20% when the S&P is up 6. Emerging markets up as well. So, as we think about our aggregate equity positioning, right, we do think that there remains some pretty substantial opportunities outside of the United States, even in spite of kind of the year-to-date head start. And part of it is because of what we just went through on that fragility here in the U.S. with valuations.
So pausing for a moment, we've been advocates of having some portion of your equities in international for a long time, and it's been a long time since it was really additive. So if you could show briefly how it's been additive this year, and then what piece of it's from local currency and what piece of it's from the US dollar devaluing, I think that might be useful.
Yeah, part of it has come from, as you just mentioned, it's come from the US dollar has been weaker year to date. Now, while the US dollar is down, it is not down um, all that much relative to history. Sorry, am I sharing my screen here?
Yep, it was up
Oh,
and now it's not.
sorry.
All the time.
Um, so as we look at, where we sit from just kind of a year to date start, right? It's the best year to date start for international markets in the last 2 decades. Now, when we look across all these various regions, right? So the US is up 6. If we look at all countries outside of the United States, just on an average basis or a weighted average basis, they're up 8.8%. But that's, developed and emerging. The difference here would be currency, right? So
So
if
they're
the
up
US
17, but 8% of it's local currency.
exactly. So if
Just
you were, you know, in China trading in renminbi, right, your market is up. And if you're in the US trading in China, the dollar is also weaker. The two of those add together to create the total return. So strong local markets plus a weaker dollar have benefited total return for investors. Now that gets kind of begs the question of like what's going on with the dollar. The dollar is objectively weaker, right? It's down 11% year to date, but if you look back, since the 1980s, it's really only rewinded the clock a handful of years. It's still well above average. It's had a lot lower lows, and frankly, it's had higher highs. And just like the idea of the independence of the Fed, kind of the death of that there, we would say, it's largely been extrapolated, that the US would lose reserve currency status. We do not think that that is or will be the case for a whole host of reasons, some of which very rooted in economic founding, that the US is still the vastly most common, foreign exchange and transaction invoicing FX reserves, but also for other reasons, right, that are non-economic, like military reasons, diplomatic reasons, rule of law, and political stability. And so, dollar weakening has been a tailwind for our global portfolios, which has been great. But we don't think that just because you have a weaker dollar means, you lose reserve currency status.
okay. So it's funny. 2 years ago, we never talked about our budget deficit and deficits ongoing. And now I think the overall debt is about 37 trillion or something like that. And this big beautiful bill is, as you mentioned, is projected to add 3.4 trillion to that debt. And the question comes up at some point, it's going to come home to roost. Um, how do you think we get out of this? What do you think the implications are for the market? Is there any special positioning in your view that we need to take now, or do we delay taking any certain actions to protect against that?
So, it'll have to come from a balance of uh, fiscal austerity, right? If we keep spending more than we take in receipts, right? And that's what we just passed. We largely cut taxes. We also cut spending a little bit, but not by the same amount. So it's pretty simple math. The revenue of the federal government is tax receipts, and we spend more than that every year. That's adding to our deficit, and that's a Republican issue today with OBBB passing. But we've been doing this really since Clinton, right? And we've been doing it, through blue regimes, through red regimes, and through purple regimes. So it's going to take some level of fiscal austerity where we don't spend more. Frankly, we need to spend less than fiscal receipts. You want a growing economy, which we have today, right? So as the economy grows in aggregate, your fiscal receipts, your receipts from taxes should continue to come in. And then, which is one of the explicit objectives or interests of President Trump today, is he wants lower interest rates because our interest payments are become a higher and higher percentage of our overall spending. Frankly, soon to surpass in the next handful of years what we spend on Social Security, Medicare, Medicaid, and then even defense. So if we don't have lower interest rates, that will become even more expensive. Now, as we just discussed, the Fed doesn't control that. They can lower the front end of the curve, but long-term interest rates could remain high. And what will ultimately lower long-term interest rates is a growing economy, some type of fiscal austerity and responsibility that's, seen on a sustainable basis, and trust that ultimately we won't just keep kicking the can and spending more, that will ultimately, make sound fiscal decisions and not run more on the till.
As it's been, and so far the answer, what do they say? Diversification is the worst form of investing except for every other, right?
It's the Winston Churchill on
Yeah,
democracy. Yeah, that's exactly
democracy.
right.
Do you see as we move forward, do you see new asset classes in the next 3, 5, 7 years making its way into portfolios?
I mean, look, that is something we're always on the hunt for. Every day. We would love to find things that either add to return, reduce risk, or hopefully do both. And there are a number of uh, great candidates out there, whether it be, in the alternative landscape. It could be, yeah, I know you mentioned you've got kind of a later series on crypto or gold. Those are big discussions, in today's market. But that's something we're constantly on the hunt. So honestly, yes, I would expect some type of changes over the next couple of years. Now, that being said, there's nothing immediate, right? We feel like the portfolio we have in the ground today is the very best, and the world is our oyster, right? We can own anything under the sun. And what we've chosen to own today is having carefully curated all these. So sitting here 3 years forward, I would absolutely hope, we've got, new opportunities, new assets, or maybe the same old asset, but it's presenting in a different way, right? Because prices change all the time. That can continue to be a great opportunity for investors.
Fantastic. We're at a little over 30 minutes, and we promised a certain time. Any concluding remarks you'd like to make, or advice you'd like to render?
I mean, look, we're a little over halfway through the year, and it feels like we're just getting started, right? The clock is running pretty quick here. Feel very confident in how we position portfolios, especially, with what we've seen and where the opportunities lie going forward. A lot of wood left to chop on the year. We still have to get through tariffs. We still feel like, we've gone from liberation to limbo. But it also, those kind of periods of volatility do present great opportunities. So I would harken it back to where we started, right? In that, long-term compounding, eighth wonder of the world, and thoughtful diversification. I think that's really being exemplified in portfolios today. So, still a lot left in 2025 in the tank and beyond, but we feel like we're in a really great spot.
Great. Brad, I can't thank you enough. Thank you to all of our clients and friends who are listening in or hear this on replay. Again, today's date is July 22nd, so keep that in mind when you're re-listening to this particular webinar. Brad, thank you. Have a great
Yeah.
rest of the day and great rest of the summer.
All right. Thanks, everybody.
Thank you. Bye-bye.